So I do get asked this question quite a bit, is how to draw trend lines properly, and there's some basic rules that we need to know, and there is a rule book to follow. Now over here in the UK I teach on the Society of Technical Analysts Diploma program, which is the official qualification if you want to become a technical analyst, so I should know the rule book pretty well, and this one on trend lines is really quite straightforward, and I'm going to cover it off very quickly here. So for those new to technical analysis, what exactly is a trend line? Well, it is simply on your charts drawing a line to try and signify a trend in the price or data set that you are looking at, whether that's up, down or sideways. And I suppose one of the very first rules you will need to know is that it is a very subjective process, and that means you could put 100 technical analysts in one room and give them the same chart and they'll all come back to you with different trend lines and analysis. That's what makes technical analysis and trading so different and so exciting. Everyone has a different point of view. So rule number one is trend line drawing is a very subjective process, and we try and make that as objective as possible by adding, like I say, this rule set, rule book process to the trend line drawing application. But it's nothing more than, like I say, these straight trend lines drawn on the price or whatever data set you're looking at. It could be volatility, volume, any other input, to try and signify where the price is going, either up, down or sideways. So we've already met rule one, which is drawing trend lines is a very subjective process, and that we're trying to move them towards more objectivity in our decision making process. And don't worry too much, I'm going to cover off the rest of the rules here quickly, and then we're going to go into some practical examples to cement your learning. So we can't just draw on lines willy-nilly and call them a trend. They have to be confirmed trends and they have to follow a basic rule set. So that is the starter, rule number 2, which then leads us into the detail, which is rule number 3. So we've got two parts to this rule. The tentative trend is the weak trend, not quite confirmed, but it's a, like I say, a sort of trend. And then we've got the confirmed trend, the definitive trend. And the difference between the two is the tentative trend has 2 touches on the data that you're drawing or analysing, and the confirmed trend has a third more significant touch, and if it has even more than 3 touches, then that adds to even more trend significance. So for example, if you had 5 touches and then on the 6th it breaks through, then that is a very significant happening, and like I said, the more it touches, the more significant it is. So what about trend line steepness? Well, that's covered in rule number 4. The most important, the strongest trend lines average a 45-degree slope. Now, if you get into technical analysis, that is a very similar principle used in Gann theory, and it's that 45 degrees, whether it's up or down, is, like I said, the strongest, most important trend line. So you already may have your favourite chart type, but you can actually draw trend lines on all sorts of chart types, whether that's Kagi, Renko, point and figure, line, bar charts. And another important factor is that it all works on all time frames, and the important takeaway there is that the same rules apply to whatever chart you are using. So one of the most important rules, and what you've all been wanting to know, is how do you draw these trend lines actually on the charts? Well, you draw trend lines through the lows in an uptrend and through the highs in a downtrend. And remember that rule is a discretionary drawing process. So for an uptrend, the lines go under the data, and for a downtrend, it's above the data. So a couple of examples for you here. We've got the uptrend with the 3 confirmed touches. See how they touch 1, 2, 3, those points on that trend line, and it's the opposite for the downtrend. Notice where the trend line is on the downtrend, it's above the data and below the data for the uptrend. Now, a slight derivative of the trend line is the trend line channel. Just imagine them as two parallel lines, either up or down. They have some basic rules. You start for the up trend line channels as normal, draw your trend line, and then you project a parallel line above that, and that is relative to the high in your analysis, and it's exactly the opposite to the downside. Again, we'll look at some examples in a minute, but I've just drawn some rough ones so you can get an idea visually. I really like these trend channels because they give you the opportunity to trade the price in that range, to the up and downside, so it bounces off either side of the channel. So it's a really useful tool to see whether price is, like I say, trading within that channel range. And on the left we've got the up channel, and you can see the high point there marked out. You just move that bottom line in parallel to join that, and it's the opposite for the downside, whereas you're looking for that low. Now, the final rule here, number 8, is all about trend line length. Now, remember the rules of trend length. You have 3 of them. The major one is from now until 6 months, a year out. Then we've got intermediate, 3 weeks to 6 months, and then the near one, less than 3 weeks. So if you've got a daily chart up and you're drawing a trend line that covers over a year's worth of data, then that is a very significant trend, and when that gets broken or it touches and bounces, then again it's at high significance. And then those shorter trend lines you're drawing, well, they are of less significance. So something to think about when you are actually drawing your trend lines, and what some people forget about when they're actually putting them together is the actual importance of the length of that trend line. So now we've covered that, let's move on to some practical examples and how you can go about drawing trend lines within your chart package. Now, I'm using TradingView for this example, but it's going to be exactly the same in any chart package you use. Now, I've pulled up a random daily chart of Bitcoin to show some practical drawing examples here. Remember the rule of subjectivity, the first one. So what I might draw is completely different to what you agree with, but we're going to just do this for practical sake. Now, on TradingView, up on the left here, we have different trend lines that we can draw, and we're going to use this one called trend line. And first of all, I'm going to look for an uptrend here, and I can see that bottom low there. There's the second one there, and I'm going to draw that over. Does it touch? Well, it touches a third one quite conveniently there, and then look what happens. Instantly the next day it breaks, and that does prove a very important break to the downside as the price came off a lot more heavily. Now, that is me drawing a subjective trend line, and you can spend a very long time going through the data. Again, let's just pick a tentative, I see a tentative one here, maybe a downtrend. Remember, that's above the data. Now, actually, you got 3 touches, 1, 2, 3, then it breaks out, and then you will learn how the price often comes back to the trend line and can revert and move on backwards. This one failed, came back in to our now looking like wedge pattern before it broke down to that size. If I continue that on further, makes it look more of a wedge downward trend. Bang, broke. So this is how you piece the information together, and like I said, you can draw to your heart's content. It's totally up to you. Let's find the parallel channel tool that we talked about as well. There it is. Harder to find parallel channels. I'm only making this one up. We got 2, 3 touches, and our low is there. So there we go. That's our down channel. See how the price behaves in it. It breaks out. 1, 2, 3 on that 4th break, and then it's gone on up. So that's some practical examples. Let's just have a look at another real life example on the S&P 500. So I've now got the E-minis for the S&P 500, and I've gone out to a weekly chart, and like I said, these trend lines work in all time frames. Again, let's go and look at the parallel channel, see if we can get something going here. We got 1, 2, 3 touches down there. We drag that up to that high, which is down there. Actually, this one, a couple of touches up, bounces here, then breaks, and we're in that current downtrend. And also on these trend line rules, remember I said that you can use it on any chart, so I'm going to find a Renko chart, and I've just changed the E-mini contract there to a Renko chart, used a $15 block size, and it will be exactly the same. We want to get our trend lines, we draw them, we can see that downtrend, maybe there and there. 2 touches, not so strong. On the third it broke up. Again, you can use them in flat trend lines for support. You don't have to draw them quite as long as that other one. Maybe shorter trend lines within trend lines, and even you could probably draw on parallels to that. That's just to give you an example that it works on all types of charts, all types of time frames. And remember, it's a subjective process. Use those 8 rules that we covered off to make it as objective as possible, and that will give you the best chance of success. So I hope you've enjoyed this quick tutorial on drawing trend lines properly by the book. And if you want to get more heavily into the world of technical analysis, I've got a great video out there on YouTube for free. It's a course on the basics, an introduction to technical analysis, and if you want to see that, it's right here.